Ladies and gentlemen, this is Bert Dohmen with a chart predictor. I have to apologize for not doing one for some time, but it's been very busy, lots of travels, lots of new projects we're working on in the office, and actually dull markets this summer. Okay, but now it's getting more exciting, especially the election will give us more excitement than we probably want. Let's look at the U.S. dollar chart. This is very interesting right now. This is the dollar index, which is actually a basket of different currencies versus the U.S. dollar. And you could see here at the top, it was in 2002, which was the end of our big recession from 2000 to 2002. And recessions always produce big monetary stimulus, which weakens the currency. So this is the result of the Federal Reserve stepping on the accelerator, and it lowered the value of the dollar right into 2008. And then we had the rise in the US dollar starting. Now, you would think that as the central bank, the Federal Reserve, starts stepping on the accelerator, the dollar would decline again, but it didn't because other countries stepped on the accelerator even harder. And this is what we're seeing now. We have a beautiful long-term bottom. Look at this is a shoulder, this is a head, and this is a shoulder. So that's an inverted head and shoulder, which is very bullish, especially a long-term pattern like this. 2005 was a shoulder, then the low was 2008, and then another shoulder here in 2014. So such a broad head and shoulder inverted pattern is very bullish and really supports a big up move in the dollar. This is going to be the number one currency for the next several years, in our opinion. The next resistance here is going to be just above the 100 area, which is the 2015 high. And if that is successfully penetrated, eventually, in several years, it will not be in a few weeks or a few months, we'll get back to 120, which would be an extraordinarily profitable move if you trade the Forex markets. Now, what are the implications for other markets? Well, a strong dollar will be very bearish for the precious metals. This is something that we have to worry about. And we have to think about uh, the long-term case for the precious metals. It might be interrupted because of the strong US dollar. It would also be a headwind for a stronger energy prices. And would actually be beneficial for long-term treasury bonds because it would make the US dollar-based investments such as treasuries that much more attractive for foreign buyers. So there are lots of implications of this, and we discuss these always in our Wellington letter, which we now issue several times a month. And this is really the way to stay on top. We cannot make one prediction regarding all the different markets we follow just in a video like this. So if you want to stay tuned with our research, which is very thorough, I don't think you can find anything close to it anywhere else, then get the Wellington letter. It's a bargain. All right, thank you very much for joining us today, and we'll try to update now more frequently as time goes by, but this is definitely not a substitute for getting the Wellington letter, which often is, 15 to 24 pages. Thank you. Bye.